Have you ever stopped to consider if it's truly possible to generate income from your investments without actually selling any of your assets? It's a question many aspiring investors ponder. Well, that's precisely the allure and the magic behind dividend investing. It's a strategy that allows your money to work for you. You essentially get paid simply for owning a piece of a company. There's absolutely no need to sell your shares to realize a return. You are rewarded for your investment and belief in the company's future. Even when you start with just a small amount of capital, you can begin the exciting journey of building a consistent stream of cash that has the potential to grow substantially over time, thanks to the power of compounding. When you strategically buy shares of specific dividend-paying companies, they, in turn, reward you by paying out a portion of their hard-earned profits. And this payment is what we call a dividend. And now, thanks to the proliferation of user-friendly apps that conveniently allow you to buy fractional shares, you can realistically get started on your dividend investing journey with just a few dollars in hand. Many beginners find dividend investing particularly appealing because it's relatively simple to understand and implement. Plus, it doesn't demand constant monitoring or stressful, frequent trading decisions. And the best part is that over time, those seemingly small dividend payments can truly accumulate and make a significant difference to your overall returns. So let's delve deeper and break down exactly what dividend stocks are all about, and explore how you can strategically use them as a powerful tool to build your very own, reliable stream of passive income. Dividend stocks are shares of companies that pay you money regularly, often every 3 months. Big stable companies like Coca-Cola and Johnson & Johnson are famous for this. When you own their stock, you get a piece of their profits sent right to your account. Dividend yield is the percentage of the stock price you get back as dividends each year. Not all stocks pay dividends. Many tech companies reinvest profits instead. Blue-chip stocks with a long history of paying dividends are a safe place for beginners. Next, let's look at how to pick the best dividend stocks for your portfolio. Picking the right dividend stocks really matters when you're aiming for a steady income stream or long-term growth. It's not just about finding any stock that pays a dividend, it's about identifying companies that can reliably maintain and even increase those payouts over time. First, check the dividend yield. This tells you what percentage of the stock price you'll receive annually in dividends. Financial experts often suggest looking for yields between 2 and 5% for a reasonable balance of income and safety. A yield outside this range might signal higher risk. Next, take a close look at the payout ratio. A payout ratio below 60% is usually a good sign, indicating the company retains enough earnings to reinvest in its business and sustain future dividends. If the payout ratio is too high, approaching or exceeding 100%, the company might be forced to cut its dividend if profits drop, as they are paying out more than they earn. Examining the company's history is also important. Look for companies that are considered dividend aristocrats. These companies have a proven track record of paying and increasing their dividends for many consecutive years, showcasing their financial stability. You can easily find lists of these dividend aristocrats online or in financial guides, such as those provided by Investopedia. Before investing, do a bit of your own research. Ask yourself, is the company demonstrating consistent growth, generating steady profits, and operating within a relatively stable industry? You don't need to be a financial expert to do this. Just read some recent news articles about the company and check their investor relations website for key information. This basic research will significantly help you avoid potentially risky stocks that might jeopardize your investment. By performing these simple checks, you can build a strong foundation for your investment portfolio and increase your chances of long-term success. One of the most effective strategies to accelerate the growth of your passive income streams is by strategically reinvesting the dividends you receive. This powerful technique is commonly referred to as a DRIP, short for Dividend Reinvestment Plan. With a DRIP in place, your dividends are automatically used to purchase additional shares of the company, which in turn accelerates the growth of your overall investment portfolio. Fortunately, many modern investment apps and brokerage platforms such as Robinhood and Fidelity have streamlined this process, making it incredibly easy to get started, even if you're only working with small investment amounts. The ability to buy fractional shares means that every single dollar you invest is actively working to generate more income for you. But it's crucial to remember that all investments, including dividend stocks, carry inherent risks. Stock prices can fluctuate and potentially decline, and companies may at times reduce or even eliminate their dividend payouts. To mitigate these risks, It's essential to diversify your portfolio by owning shares in a variety of different companies, spanning across multiple industries and sectors. Above all, patience is key. The true benefits of dividend investing are typically realized over the long term, often unfolding over many years. To further enhance your understanding, check out free resources like the Investopedia Dividend Investing Guide. You can also explore my YouTube channel, where I share even more insights and strategies. And don't forget to download your free dividend investing checklist below, and stay tuned for more valuable tips and strategies to help you on your journey to financial freedom.